2 days ago, the Fed raised its expectations for inflation for the year and brought forward the time frame of when they may expect to raise interest rates, giving an indication of late 2023. They also talked about potentially tapering, but gave no indication of timing. Honestly, we've seen this week the dollar strengthen, materials and precious metals sold off a bit. But the reality, the Fed is doing a lot of talking and not walking. In all honesty, the Fed must continue to monetize if they're going to raise GDP. I mean, since the beginning of the pandemic, the Fed is really bought over 50% of total U.S. Treasury issuance. So total U.S. Treasury issuance of $4.5 trillion, they've bought over 50%. That's just an astronomical amount of money. And so this is really the only game in town. So we expect that to continue. And we don't, in the long run, expect the Fed to be able to ultimately raise rates. So that's where we are today. So if
I'm going to kind of take a couple steps back here.
Sure.
The Fed's easy money policies have been in place since the kind of heels in the wake of the great financial crisis. Now we got to go back to 2009, 2010, kind of that range, right? Yeah. It's been in place for over a decade now. The stock markets have made a V-shaped recovery a couple of different times during that time span from the financial crisis, and then even quicker from the virus pandemic. Is there a case to be made that the Fed is doing the right thing by keeping interest rates low if equity valuations are where they are? Or does the Fed need to, is it its responsibility to take a more holistic view of what's happening with asset prices overall in this kind of a market?
Well, I think they'd like to manage asset prices, but in reality, if they need to continue to increase GDP, they have to monetize. There's no other thing they can possibly do. When we listen to management teams and speak to them frequently and listen to earnings calls, the number one thing that companies will talk about is their supply chain, right? So when you think about what happened during COVID, supply chains were basically frozen, and companies are willing to forego cost and efficiency, frankly, for security of their supply chains. And by definition, if you're going to forego cost, that's automatically inflationary. So when you think about the Fed going forward, I think it's going to be very, very difficult for them to raise interest rates, because in easy monetary policy, yes, it keeps asset prices inflated, but there's no way they're going to be able to influence, social programs that the government would like to do.
Sure.
And we'll see that going on for many, many years.
All right, Patrick, with all of that in mind, we got about 30 seconds left here. Your stock picks, your industry picks, what are you buying?
Well, we really like precious metals. And so one example would be Franco-Nevada. They're a royalty and streaming company. They really don't take any operational risk. They have a royalty stream of revenue for gold and some other materials like iron ore. They have high EBITDA margins north of 80%. So you have a $20 billion market company with 35 employees. I'd say that's pretty decent risk reward.
Shepard Smith here. Thanks for watching CNBC on YouTube.